Major economies are staring at a recession. The United States, the United Kingdom, Japan, South Korea, Australia, Canada and the Eurozone.
I think the consensus is more or less that inflation has peaked.
CEO of Amazon, Andy Jassy, said the cuts will amount to 6%.
Recently, I summarised our strategic view as think what you did over the last decade and do the opposite. But what does that mean for markets in 2023? Let's start with the epicenter of weakness in 2022, fixed income. Now, we expect inflation to be structurally higher for a number of reasons, such as rising wages, deglobalisation and decarbonisation. Of course, we'll still get cycles in inflation, and we expect inflation to be weaker this year. But ultimately, central banks won't be able to go back to the zero-rate policies that characterised the last decade. And we won't be able to rely on the negative correlation between equities and bonds anymore.
A long recession, falling growth, rising unemployment, and in Petersfield in Hampshire, an anxious wait for an announcement on interest rates.
With the potential for greater rate volatility and the reduced diversification benefits of bonds, will need to be compensated through higher yields. Now, the good news is that after the significant repricing of 2022 and with the risk of recession in 2023, we think bonds could offer an attractive yield for 2023.
Iran plans to send about 1,000 more weapons to Russia, including advanced guided missiles for Moscow's war in Ukraine.
A growing number of countries now require people arriving from China to show negative COVID-19 tests.
North Korea marked the start of the new year with several weapons tests. It could be on the verge of a fresh nuclear test.
With geopolitical tension running high, we continue to believe that commodities and commodity-related investments provide an important source of diversification.
On the US economic front, according to an industry survey, manufacturing growth slowed in September to its weakest pace in more than 2 years.
The last decade was dominated by the outperformance of US assets, both equities and bonds. We now see greater opportunity for regional diversification. Within fixed income, a number of emerging market economies are further along in the battle against inflation and offer quite solid macroeconomic fundamentals. Yields are attractive, particularly in local currency, and combined with a significant level of underinvestment after the turbulence over the last decade, we actually see significant opportunities in emerging market debt. We're also starting to differentiate more within equities as regions outside of the US offer compelling valuations. In the US, we're still at record levels of margin, and cost pressures are starting to rise while revenue growth is starting to slow. In the rest of the world, things are more interesting. We expect China to recover strongly as it exits its zero-COVID policy. And the financial sectors of Europe and Japan are benefiting from the move away from zero or negative yields. Lastly, a word on overall risk levels. While we expect interest rate volatility to stabilise, we do still expect central banks to keep policy tight. And combined with the risk of recession, this is likely to continue to put pressure on equity valuations. So we would balance our more pro-cyclical positions with underweight positions in US equities. So in conclusion, there are opportunities to take advantage of after the turbulence of 2022, but do keep some dry powder.